Before you buy a house in 2026, I want you to imagine something. You find the perfect place, good neighborhood, decent schools, clean inspection, maybe even the little backyard. You run the numbers, tell yourself, if I don't buy now, I'll be priced out forever. And then you lock in a mortgage around 6.3 to 6.4%. What nobody tells you is that in this market, the biggest risk may not be the price of the house. It may be the price of being wrong about your timing. As of April 9, 2026, Freddie Mac's average 30-year fixed mortgage rate was 6.37%, and the 15-year was 5.74%. That is a radically different world from the 3% mortgage era people still compare everything to in their heads. And here's why this matters. In March 2026, the National Association of Realtors said the median existing home price hit $408,800, while Redfin put the broader U.S. sale price at $436,705. Home prices nationally are still rising, but only modestly, around 1.2 to 1.6% year over year, depending on the measure you use. So, this is not 2021 when prices were exploding. This is a market where prices are sticky, financing is expensive, and one bad personal decision can trap your cash flow for years. So this video is not about whether housing will crash tomorrow. That's the wrong question. The real question is this: if you buy a house in 2026, are you buying an asset, or are you buying a monthly payment that will quietly suffocate your financial future? Stay with me, because by the end of this video, I'm going to give you the exact framework I would use if I were buying in America right now. The biggest lie in U.S. real estate is this: if rates fall later, I can always refinance, so I should just buy now. That sounds reasonable. It sounds mature. It sounds like what a long-term investor would say. But in the real world, refinancing is not a strategy. It is a hope. And hope is dangerous when you're making a 30-year decision. Redfin's 2026 forecast expects the average 30-year mortgage rate to be about 6.3% for the year, down only modestly from 6.6% in 2025. They also expect the median U.S. home sale price to rise just 1% in 2026, and existing home sales to rise about 3% to an annualized 4.2 million. That is not a forecast for a booming market. That is a forecast for a market crawling forward while affordability stays tight. Now let's translate that into real money. At a $408,800 home price, if you put 10% down and borrow the rest at 6.37%, your principal and interest payment is roughly $2,294 per month. That is before property taxes, homeowners insurance, maintenance, repairs, closing costs, utilities, and HOA fees. Put 20% down, and the principal and interest payment is still roughly $2,039 per month. At a 3% mortgage rate on the same home with 20% down, that payment would be about $1,379 per month. That's roughly a $660 monthly gap, or nearly $8,000 a year, before the other ownership costs even show up. That is the trap. People are still shopping emotionally using yesterday's payment psychology. They look at a house and think, that price seems normal, but the payment is not normal. The payment is the economy. The payment is the investment. The payment is the lifestyle, and the payment in 2026 is still punishing. Here's the part that could save you tens of thousands of dollars. Nationally, many buyers are still behaving as if there's no inventory, no negotiating power, no room to wait. But the data say the market has changed. Redfin reported that in February 2026, there were 629,808 more home sellers than buyers in the U.S. market. That means sellers outnumbered buyers by 46.3%, the biggest gap in Redfin's records going back to 2013. Their explanation was simple: high prices, high mortgage rates, layoffs, and economic uncertainty pushed buyers to retreat, while inventory rose as the mortgage lock-in effect began to ease and new construction added supply. Then, look at price cuts. In February 2026, 34.2% of sellers cut their list price, up from 31.5% a year earlier. That was the highest February share in Redfin's data going back to 2012. Translation? A third of sellers were blinking. This matters because many Americans are still negotiating as if every house has 5 offers and a waived inspection. That is not the national reality anymore. In March 2026, Redfin's national data showed homes taking a median 55 days to sell, with a 98.7% sale-to-list ratio. That means many homes are not selling above ask, they're selling below it. So if you are still acting like you need to rush, waive protections, stretch your budget, and bid emotionally, you may be importing 2021 behavior into a 2026 market, and that is how people overpay. This is the part where a lot of people get confused. They hear that housing inventory is better, that price cuts are rising, that sellers outnumber buyers, and they assume a crash must be right around the corner. Maybe in a few local markets, maybe in some overheated Sunbelt pockets, maybe in specific zip codes where new construction surged too fast. But nationally, that's not what the data show. The FHFA said U.S. house prices were up 1.6% from January 2025 to January 2026. Redfin said national prices in March 2026 were up 1.2% year-over-year. NAR said the median existing home price in March was up 1.4% from a year earlier. So yes, price growth has cooled dramatically, but cooled is not the same as crashing. Why haven't prices fallen harder? Because most owners are not distressed. They're locked into ultra-low mortgages from prior years. Redfin specifically noted that prices aren't expected to fall much nationally because many potential sellers have strong equity positions, low existing rates, and solid credit, which means they can wait rather than dump homes in a panic. That means 2026 is dangerous in a different way. The danger is not necessarily that you buy and instantly lose 30% on paper. The danger is that you buy into a market where upside is limited, payment pressure is high, and your cash gets trapped in a house that may underperform simpler alternatives for several years. In other words, you may not get a crash, but you also may not get bailed out. Now let's talk about the comparison almost nobody makes, honestly. If buying is so obviously superior, why is the rental market softening? Apartment List reported that the national median rent in March 2026 was $1,363, up 4% month-over-month, but down 1.7% year-over-year. Rents were down 5.5% from their 2022 peak, while the national multifamily vacancy rate held at 7.3%, the highest level in their data going back to 2017. Units were taking an average of 38 days to lease. Now, compare that to ownership math. Even a financed payment around $2,000 to $2,300 per month in principal and interest alone can easily become $2,700 to $3,300 all in once you add taxes, insurance, repairs, and the normal chaos of owning a home in America. Meanwhile, the median national rent is $1,363. Of course, this varies wildly by metro, by home type, by school district, and by family size. But nationally, renting is no longer the embarrassing throwing money away option many people still pretend it is. In a lot of cases, renting is the more flexible, less risky capital allocation decision. And that flexibility matters. If you rent and save the difference between rent and ownership costs, you keep liquidity. You keep optionality. You keep the ability to move for a better job, survive a layoff, buy later at a better payment, or invest the spread into index funds, treasury bills, or your own business. A house can build wealth, but only if the payment doesn't crush your ability to build wealth everywhere else. This is where we move from housing to the broader U.S. economy. The New York Fed said total household debt hit $18.8 trillion in Q4 2025. Mortgage balances alone were $13.17 trillion. They also said mortgage delinquencies were increasing, though still near historically normal levels, with stress concentrated in lower income areas and places where home prices were declining. At the same time, the Federal Reserve's mortgage debt service ratio shows mortgage payments as a share of disposable personal income have been climbing again. And NAR's March 2026 Housing Affordability Index was 113.7, down from 117.5 in February, though better than 104.2 a year earlier. On that index, 100 means a median income family has exactly enough income to qualify for a mortgage on a median-priced home. So yes, affordability has improved from a year ago, but that does not mean housing is cheap. It means housing is slightly less brutal than it was. And while shelter inflation has cooled, it's still there. The Bureau of Labor Statistics said shelter inflation was up 3.0% over the prior 12 months in March 2026 and 0.3% in the month itself. So here is the hidden enemy in 2026: cash flow fragility. If you lose a job, if your bonus disappears, if you need a car, if childcare rises, if insurance jumps, if your property taxes reset, if your roof leaks, if one parent wants to reduce hours, if a recession hits your industry, then the problem is not what Zillow says your house is worth. The problem is that your fixed monthly burn rate got too high. That is the part of housing risk that people only understand after closing. Some buyers hear all this and think, fine, I'll just buy new construction. Builders are offering incentives. And yes, sometimes that's smart. The Census Bureau said new home sales in January 2026 ran at a seasonally adjusted annual rate of 587,000, with a median sales price of $400,500 at a hefty 9.7-month supply. That's a meaningful amount of supply, and it tells you builders in some areas may have more motivation than resale sellers do. But incentives can be deceptive. A builder may offer a rate buy-down, closing cost help, or upgrades. Great, but if the underlying home price is still inflated relative to local income, future resale demand, or neighborhood competition, then what looks like a deal today can become a weak resale tomorrow. A rate buy-down is wonderful if you are already buying the right house at the right price. It is not wonderful if it seduces you into overbuying. So when a builder says, we'll get you from 6.5% to 5.5%, your next question should be, at what effective price? Because in finance, incentives are never free. They're just moved around on the spreadsheet. If I were buying a house in the US in 2026, I would not ask, can I qualify? I would ask 5 harder questions. First, can I comfortably carry this payment if nothing goes right for 12 months? Not if everything goes right, not if I get the raise, not if I refinance, not if I Airbnb the basement, not if the market bails me out. If your housing payment only works in your optimistic scenario, you are already taking too much risk. Second, am I buying for at least 7 to 10 years? In a high-friction market with higher rates, the shorter your holding period, the more dangerous buying becomes. Transaction costs matter. Opportunity cost matters. If there's a realistic chance you move in 3 years, renting often wins. Third, am I buying because the numbers work or because I'm emotionally exhausted? A lot of people don't buy because it's a great investment. They buy because they're tired of uncertainty, tired of landlords, tired of scrolling listings, tired of feeling behind. That emotional fatigue is real, but it is expensive. Fourth, is my local market actually softening, or am I using national headlines to justify a bad local decision? National data matter, but housing is still local. Some markets have rising supply and falling rents. Some are still tight. Some have heavy new construction competition. Some have insurance problems. Some have tax shocks. You do not buy the national housing market. You buy one asset on one street in one labor market. And fifth, what am I giving up by owning this house? If buying wipes out your emergency fund, kills your retirement contributions, delays business investment, or turns your cash flow into a monthly hostage situation, then the house is not building wealth, it is replacing wealth. Here's my honest answer. For most Americans, do not buy a house in 2026 just because you think prices will run away from you again. The data do not support panic buying. Sales are sluggish. Sellers outnumber buyers nationally. Price cuts are elevated. Price growth is modest. Rent is soft in many markets. You have more leverage than buyers realize. But I'm not saying never buy. If you have stable income, strong reserves, low other debt, a long time horizon, and you can buy a house you truly want at a payment that still leaves room to invest, then 2026 can still work. In fact, this kind of slower, more negotiable market can be better for disciplined buyers than the chaos of the pandemic years. Redfin expects only mild price growth and slightly better affordability as wage growth outpaces home price growth. So the real conclusion is this: don't buy a house in 2026 because you're afraid. Buy one only if your balance sheet can carry it, your timeline justifies it, and the specific deal is good enough that you would still sleep well if prices went nowhere for the next 3 years. That is how adults buy real estate. If you remember nothing else from this video, remember this sentence. In 2026, the house is not the investment. The spread between your housing cost and your earning power is the investment. That's the game. If the payment is too high, the house owns you. If the payment is manageable, the house can become a powerful long-term asset. The difference is not optimism. The difference is discipline. So before you buy, run the numbers, stress test your job, study your local inventory, compare the all-in ownership cost to rent, negotiate harder than you think you need to, and never let a realtor, a lender, a headline, or your own anxiety rush you into a 30-year commitment you haven't pressure tested. Because the people who build wealth in housing are not the people who buy the fastest. They're the people who buy when the math is finally on their side. Thanks for watching. If this helped you clear through the noise, hit subscribe. I'll see you in the next one.